Hey everyone, my name is Daniel Heidel here with Integritas Wealth Strategies on this fine morning. I wanted to share a little insight right here just because I was recently at a conference and I heard from a brilliant economist named David Bahnsen, and he spoke a lot about different market movements that are occurring, some of the growth that we're seeing, and some of the inefficiencies and areas where risk is not being rewarded right now. And one of those tends to happen with the markets that we're seeing. There's a lot of sentiment. There's a lot of strong feelings about U.S. growth, specifically in the S&P 500 index. Markets, people are expecting them to soar. There's plays, short-term swing trades all the time, basically betting on things going up or down very quickly. Much of it can be considered to be government related. So right now we're hearing a lot about tariffs and taxes, and those things are important nonetheless. But a lot of this boils down to some simpler things that David pointed out very, very well and very clearly. He does an amazing job at really making complex macroeconomical things that are going on in the world very simple to understand and very easy to communicate to clients. So I'm going to do my best to kind of replicate some of his conversation and give it to you as a little brief insight. I'm going to boil down about an hour-long conversation into roughly 10 minutes. So this isn't going to be perfect, but if you're ever interested, go and check out the David Bahnsen Group. He's on YouTube. He has a podcast. I'm not paid for any of this. I just think he's a brilliant economist and he does great work, quite frankly. So one of the things that David points out is that right now, markets are very much overbought. They're expensive. And this includes the S&P 500 index. You know, we hear all the time in the news that there's Mag 7 names leading the charge, and they make up such a large amount of the S&P 500 index. And much of that is because investors pour into the US and they buy. So when they buy, it kind of dries up the market capitalization of those major companies and just continues to kind of roll like that. So the negative to that is that when a stock gets so expensive and the PE ratios climb so high, there's a very direct correlation between how high the PE is and what return you can expect. So there's many different ways of looking at this and measuring it. There's the Shiller PE ratio, there's the CAPE index, Warren Buffett has his own index, and there's also a kind of a comical one, the Greenspan index, and you can look more into that as well, but it's kind of funny. It's about men buying underwear based upon when they feel economically confident and comfortable. But basically all of these things kind of have the same general idea that as PE ratios rise, return lowers. So when we have a PE ratio as high as it is now in much of the market, especially in large capitalization companies, we can see that the average return expected for that is much lower than it's been. So recently, I mean, it was abnormal for an investor to be able to just buy an index fund and expect double-digit returns. But historically speaking, when we look at the ratio, it would suggest that a high PE ratio like we've seen now might give us something closer to single-digit mid-range returns over a longer period of time. So that would essentially indicate to a lot of people that, you know, we were overbought and things are going to switch. So this isn't here to kind of spook people out of the market or out of investing. It doesn't mean you need to go and buy gold or buy cash and basically sell everything and sit on it because there's a doomsday coming or that the market is a bubble or anything like that. It's more so just there to incentivize cautious investing. So the problem that we're facing is that, you know, investors could see dramatic downturns and a lot of volatility. So for people that have been just holding to, let's buy an S&P 500 index fund and go because prices are low, we're not dealing with management fees, we're not dealing with high expense ratios, we're not getting all these dividends because The managers are selling stuff constantly, and it's hitting me with a lot of different gains and distributions that I didn't want or didn't expect. So that was a regular rhythm for a long time, and still is the case to this day, which is why it's overbought and so expensive, quite frankly. So the problem here is that when investors start to see that downturn, they're going to either try and ride it out, and if you ride it out, that's better than the other scenario in a lot of ways. But you're going to see big reductions in your returns if that happens. And it's a real possibility that exists. Now, the other thing that could happen is when you see a reduction in price and the value drops, people might sell in large chunks and flee to whatever feels safe. And that might be bonds, that might be straight to cash. And there's no one solution to this. People are going to offer you a lot of solutions. They're going to say buy Bitcoin, buy gold, the typical things that you hear. And in many scenarios, this just doesn't seem to solve things over long periods of time. If you go to cash, you miss out on the market. If you go to gold, you're typically maybe just barely beating inflation, which has been high lately. So you have to consider those things and weigh your costs and benefits. One of the major things is when you're investing, you want to take as little risk for the return as possible. So right now, the S&P 500 index, there's a risk inefficiency there. So you're not being incentivized for taking that large amount of risk. So one of the potential solutions to that is to look at asset allocation and make sure you're actually diversified. So if you're buying the S&P 500 index fund, you are more diversified than most people. And this means that you have a large basket of large U.S. companies, and you're not concentrated to one name in particular. And of course, the index is somewhat rebalanced over time because companies change. They might drop off the index. They might enter the index, and your dollars go to buying those companies. So that is a pro there. That is a pro. But the con is that if large cap U.S. companies underperform for many years at a time, you're missing out on the areas of the market where they're seeing price increases. And people are receiving gains, but you're not participating in that. So this is why the job of an advisor is important, to be able to look at those macroeconomic trends and basically be aware and recognize that, large SUs companies might underperform. And so you might buy mid-cap companies or small-cap companies or international companies or emerging markets or bonds or any one of those things. And that is what truly being diversified means. It means holding a proper share in all of those different areas of the world global market. And so one of the fascinating things that David points out is that you can almost compare and make a correlation between the performance of large U.S. companies and the performance of a country's GDP. A GDP can almost be compared to a country's growth rate or its return. So the U.S. has had moderate GDP growth. It's been good. It's been better than a lot of other countries have been around the world. By no means are we suggesting that the U.S. is headed for a doomsday scenario. So don't take that opinion from this. However, if the U.S. GDP trends downward, that trickles down to the companies inside of it. So, costs may increase, that's passed along to consumers. Taxes and tariffs can have a different conversation at play and all of that. And there can be a correlation between the return of the companies inside of a country along with their GDP growth. And it can be very, I don't want to say obvious, but the writing can sort of be on the wall. So there's a lot of economists that are out there, big banks, big wirehouses, that are all suggesting that large U.S. companies might be headed for a medium-sized return over the next several years. And that's something as investors to be aware of, right? So one of the things that you can then do to be better positioned for this is you can try to, work with a financial advisor. That's always an option for you. You can read a lot and do it yourself. It's going to take a lot of legwork to make sure you're properly positioned for these things. But you want to try and take as much risk off the table as possible. So you don't want to search for swing trades. You don't want to search for these big like momentum plays and AI. You don't want to basically search for the home runs. I talk about this a lot, but I'm a big fan of like the Moneyball theory of investing. Don't chase the home runs. Look for where there is value, and basically you want to seek like what is going to get me the average growth rate over a long period of time. Hitting like getting on base, hitting the 6%, the 7% average median returns, 8%, 9%. It's not 4, it's not 5. So you're beating inflation, but at the same time you're compounding quite significantly. Whereas if you try to chase something that you think might be a double digit, 15%, 20% return in 1 year or something, it's going to be hard to know when to get out, when to get back in, what's going to play, what's going to lose. It's tough to figure that stuff out. So this is where being a diligent investor really comes into play. So if you're interested in learning more, I suggest that you go and find an economist that you really prefer their view, that other people respect their opinions as well. Follow them, try to gain as much resources as possible. There's a lot of free things out there. There certainly are. I'm not going to try and gatekeep information from you. It's not the case. We live in a very different world now where information is readily available and everybody's here trying to educate just like I am today. Another thing you could do if you say, I'm really tired of this. I've lost a lot. I've made bad decisions with investing. I've invested in things that just didn't pan out. Or maybe I just don't even know where to start. I'm sitting in cash. My stuff isn't invested. My 401k, I didn't even realize I had investment options and it's all sitting in cash. And these are real things that I do hear quite often from investors. What you can do is you can search out a good financial advisor. And you want to look for one that will educate you. You also want to look for one that is not going to charge you exorbitant fees, because there are very high fee advisors out there, or they might have minimums that you don't meet. And that doesn't mean that you need to stay out of the market by any means. That doesn't mean that just because you don't meet their minimums that you're not a ready investor at any point. So what you can do is you can look for somebody. Now there's different options. There's robo-advisors, there's free plug-and-play things at lower costs for you, and there's also a middle ground, and that's really why I try to position myself. So instead of charging high fees, I want to meet somewhere in the middle, beat the robo-advisors, offer education, give people confidence, and that's essentially why I do this. So if you're interested in learning more, down in the description you will see a guide for 5 free tips to get started automating your investments. And this is just helpful education on different account types to use that are available to most consumers, ways to automate your savings to make sure that you're paying yourself first, and a series of different things. In addition, you'll also get some educational material that I put out, and you'll be able to stay in loop on any other videos that I post in the future as well. So I think that would be a great resource for most people. And you can go from there at your own kind of discretion. There's no force, there's no sell on any of it. It's basically when you're ready, you can jump in and be interested. So if you want to follow along and you like the education, I suggest that you subscribe to the video. Obviously, that's a way for you to stay updated on new videos that get posted. And check out the website. There's going to be a lot of helpful tips coming through there. And if you say you're ready to get started, let's jump on a call for 30 minutes and figure out where you are, what your pain points are, what your problems are, and I'll try and see if I can solve them. If I can't, I'll be very honest with you, and I'll send you some other resources, suggest some other people for you to talk to, and you can make an informed decision from there. But yeah, there's a lot of things out there, and you don't need to basically go with anybody that's telling you there's a one-size-fits-all strategy to investing. So plugging and playing in the S&P 500 index as a summary, it serves some people well, but there's a time where markets have inefficiencies and there's risks, and you need to be aware of those things as investors. So I want to give you all the information that you can get, so definitely hit subscribe, follow along, and let me know if you have any other questions.